All right, guys, let's do a quick video here on what's going on with gold. I really want to show an important chart here. Um, Most people don't understand the idea of looking at things in ratios as opposed to just looking at price. Like you see the Dow Jones, if you could see this part on my screen, it closed at 33,614. Today is a Sunday, so it closed on Friday. But they see these numbers and they think, oh yeah, the Dow Jones is going higher, but um, you have to compare it to real things in the world, like oil or gold or wheat or sugar or something like that, because this could be 50,000, right? But if everything else has gone up faster, then you're actually losing value relative to everything else. So this is a very good chart here. This is the Dow Jones Industrial Index versus gold. So if you were to price the Dow in gold, how many ounces of gold does it take to buy the Dow Jones? Um, Now looking back at this chart, you can see back in the dot-com era, I mean, the Dow Jones relative to gold just exploded, right? I think the price back here with gold maybe about 2000, 2002 was somewhere around 200, 250. I'll look at it here maybe if I remember here in a minute. But anyway, the prices were just ripping through the roof and gold wasn't doing that. So that moves this chart up, right? This is the ratio. It took, 45, right around 45, you can see on this side, 45 ounces of gold to buy the Dow Jones. But then let's say gold didn't move at all, right? Just sat there flat at whatever price it's at. The Dow is going down in nominal terms, like down in dollars price, right? As that falls, that's what this is reflecting. So even if gold just sat perfectly flat that entire time, um, this is reflecting the Dow falling. So there's different ways this chart can work. Now, if we go back in time here, if we look back into the 70s, you're hearing a lot about stagflation right now, which I think we are going to experience something like that. I don't know to what level because we don't know what the government's going to pull out of their hat here. But if we look back leading up into 1971, before Nixon took us off the gold standard right here, you had an increase in the stock price relative to the price of gold. Now, gold at that time, actually, I think it was around $44 an ounce. It was supposed to be fixed at 35 bucks an ounce, but over time they've had to revalue gold. I remember from 1933 on, so after we had the Great Depression, right? Around 1933, they didn't confiscate gold. You hear that term a lot. I mean, effectively in a way they did, but they really nationalized it, meaning they gave you money for it if you brought it into the bank to exchange for currency. The thing is, they paid you 25 bucks an ounce, and then they revalued gold at like 35 bucks an ounce. So instantly you lost purchasing power when you got your kind of ripped everybody off. But that's what they did. So anyway, they made it illegal for individuals to own gold until I think it was about 1973, somewhere around there. I'll have to look up the data on that. But you can see stock prices had continued to climb. And when Nixon took us off the gold standard, which I believe is around September 71, um, the price of gold started to rise. So this may not reflect, we could pull up that. I just don't want to lose this chart. This may not reflect the Dow going down in value, right? It could reflect gold going up in value. So the Dow is crashing relative to gold. So that's what this chart is trying to explain. Now, what I just said doesn't mean that that's what actually happened here, but there's different ways this chart's moving. Either gold's going up and it's making the Dow look like it's losing value relative to gold, or the Dow is going up, making gold look like it's losing value, but it could just be sitting still. That's what this is reflecting. But what we're looking for on charts like this is where are the bottoms in like major crisis areas that we've had in our markets. So if we go here, we can see that the Dow Jones had fell to about 1.81. Now this is a weekly chart, so I think it actually fell down to 1. So it took 1 ounce of gold to buy the Dow Jones, right? Which that means back here, the Dow, I mean, absolutely collapsed through the floor. Well, if we go over here, we see again, right around that same area, around 1, right? So in 1980, this was kind of the peak of that inflation time. From 71 into 80, Paul Volcker comes in, jacks rates to the moon. And of course, people start buying treasuries at that time. The gold price begins to fall because people want interest. So I don't know that I'd do that today because I'd be afraid the government wouldn't be able to pay me. But anyway, the point is, when you see these major crises that happen, right? We're trying to find an area that might be realistic for what's coming. So we see after the dot-com bubble. Now, keep in mind, this took years. I mean, look, this is July 99, August 99. And to really get close to the bottom, it was 10 years later, around 10 years, right? It was a long time. So you can see stock prices aren't as wild relative to gold right now like it was back here, or even back here. So you might think, oh, well, maybe stocks have more room to run then, so it could look more equivalent to this. But I don't think that's going to be the case. I mean, remember, you could see the dollar value of the Dow Jones continue to climb, right? It could just be this line that's going like this, but in reality, it's actually collapsing in value relative to gold or wheat or sugar or corn or whatever, right? Real things. So you can't get caught up in just the price of a stock or an index. That's what's just happened with the S&P 500, right? I had showed you that on some of the other videos where the S&P has this, 45-degree angle line up and to the right, but it's the way it's weighted. You have a couple stocks that are carrying this nominal line up higher, while the rest of the stocks, they're diving off at this point, right? It looks like this, right? They were dying off back here, but since Apple's 6% of the S&P 500, the weighting of it continued to carry this line up higher and higher. So you got to be careful with that type of stuff. We're trying to find real value here. Now, if we look at this right now, we can see we can still put lines on these types of charts, right? So we can see the trend of the Dow going up, and during this time, remember, gold peaked around 2011, right? It was at its highest point. The Dow and everything had fallen down. Gold had went up, so it makes this number go down. Now, it took around 6 ounces of gold to buy the Dow Jones, an equivalent dollar term value, right? So if we look at this, we realize, okay, it didn't quite drop to 1 like it did before. It doesn't necessarily mean it's going to either, but it's probably fair to say that we're going to see the gold versus Dow ratio here drop somewhere in this range at some point, right? So if we follow this chart up, we can see the trend that, yeah, after 2011, gold was falling in value in dollar terms as the Dow was rising in value all this time, right? But then after 2018, we had the repo crisis begin, and that started driving the value of gold up. And even though the Dow is climbing, if gold is rising faster, it looks like the Dow is falling. So anyway, 2020, we know what happened there. And then you see the stocks recovery. But when you look at it in terms of gold, remember, let's draw this out. Like the Dow and the S&P 500, they were going up like this. They fell when the coronavirus hit. Then it went up and they look like this. But when you look at this chart, it doesn't look that way, does it? You notice this never even reached its high compared to gold because gold was rising. So even during this period, as the Dow and the S&P 500 had risen, far above their old highs, gold was going up faster. That's what this is telling you right here. So what I see on this chart, technically, is we were following this up. There is a fair trend that was going on. We broke that trend, and now that trend has become resistance, right? And if we run a line across here, we can see there's a pretty fair amount of resistance at this level, which is telling me I think we're going to continue to see the price of gold rise over the years. And this is going to trend down. I don't know what it's going to look like, but it's going to trend down. It's going to find itself somewhere in that $6 to $1 range. So if you look at the Dow today at 33,614, the question is, if we're very realistic and we're very fair, we can say, okay, it's highly realistic that the Dow Gold ratio can drop to 6. It may not go to 1, right, without a massive crash, but let's say it can drop to 6 again, 2008 type of levels. Right? Not a big deal, very fair. If we were to drop to that level, if gold was to stay at this price, or sorry, Dow Jones was to stay at this price, which isn't going to happen, you would have gold somewhere around, let's see, what would that be, around $5,000? 33,614. Let's divide it by $5,000. 6.7. So that's very realistic. But I would say the Dow Jones is on its way down, right? So let's look at this 6 level here. Let's go check out the Dow here. Oops. Got that on still. All right. Let's flatten this out so I can fit more in here. I mean, look how different this is. Here was your 2020 crisis, right? Remember that other chart, what it looked like? It came up in 2018. We had the repo crisis, trended down. It fell with this. It climbed up. It hit this resistance zone, right? It looks nothing like this chart. That's because gold was climbing faster than this relative to its own value in dollars. So if we find some fair support zones on the Dow, right? Let's get a measuring tool here just in case to make sure. Only got a few minutes left here. Let's say we just fall back down to this old high before this whole crisis started. That's only a 20% drop, right? That's just a beginning of a bear market. That's nothing crazy, okay? And that's at 29,316. Let's see, divided by 5,000. That'd be 5.86, right? So that tells me that gold is highly likely to head towards a $5,000 zone. Now that's really barely over doubling, right? It's nothing like you'd see in crypto, but especially when we're in a time of, potential World War III, I think gold has a long way to run. So I would be watching the Dow gold ratio. I think that's going to be a pretty good indicator of when the market's bottoming out in terms of dollars. Of course, there's a lot of variables going on right now. The more money they print, you're more likely to see gold rise, although you haven't seen that in well, I was going to say the past. You have seen that in the past. That's what's happened all throughout history. It would look like this. But in today's age, people, create asset bubbles and stocks and things like that. So I think with this time of crisis, what's going on with Ukraine and Russia, we're more likely to see gold continue to increase during this time. And I think over the next 10 years, this is going to be a great play. So I was buying some Paxos gold in the crypto world last week. I get about 5% interest on it in Celsius right now. So why not have it? It's physically backed by real gold. It's part of my play on the gold sector. I also have mining stocks. Actually, I'm a client of Peter Schiff's, so follow him since 2006. So I do think we're going to have a great experience here with gold, and it should be a part of people's portfolio. But anyway, that's my breakdown of what I think is happening with gold. Be watching ratios, as it's very hard to tell by just price alone in these markets. Everything is so wigged out from just bogus economic numbers that the government puts out. And unfortunately, there's a psychology to that. But I think we're heading into some pretty wild times. But anyway, like the video, share it. I don't know where you're watching this from. I'm recording it on TradingView. Make sure to comment below, throw out your opinion so others can see it. Have a good one.